When does it make sense for an operator to elect an S-Corp versus a single member LLC?
Is the way to go in the very beginning. And over the last 4 years, the IRS is really cracking down on S-Corps and their owners who don't pay themselves a reasonable salary. The strategy we're trying to implement is to not pay FICA taxes. Is a big expense that vendingpreneurs can definitely utilize. Some people are like, I'm just gonna split my profits at the end of the day, 50-50. That doesn't exist within the IRS, right? What the IRS wants is
All right, guys, super excited to have Steven here to talk all things tax, accounting, all the fun number things as a vending operator. Steven, tell us a little about yourself.
Yeah, thanks, Mike. Thanks, Anthony. Thanks, everyone, for having me. Yeah, I joined the VP community about a month ago. The genesis of that was Cody Sanchez's YouTube video about passive income. And then so watching that, then I found Mike Hoffman. And then through Mike Hoffman, I found VP. And yeah, it's been very inspirational. And I am, in the moment, building out my routes as well. I have one pending contract out and
Congrats.
three more. Yeah, three more in the process at the moment. So fingers crossed. Yeah, fingers crossed within the next 6 weeks, possibly 4 locations.
Wow. That's awesome.
That's awesome, man.
So that kind of leads me into my first question as we think of you building your route. Like, you know, you hear all the talk about LLC, S-Corp. Let's kind of dive into that entity structure and kind of when does it make sense for an operator to elect an S-Corp versus a single member LLC? And how did you set it up for yourself?
Yeah, great question. Single member LLC is the way to go in the very beginning. And the reason I say that is because an S-Corp, there's a lot of administrative duties that come with it. Okay, so a single member LLC, first and foremost, I am not a lawyer, but what I do know is that an LLC, there is legal protection, right? When you set up an LLC versus a sole proprietorship, right? Because they are distinct entities, right? And a single member LLC, you are legally different than your personal, right? So there is that, they call it the corporate veil, where you are kind of protected, right? So you're protecting your personal assets just in case something were to go wrong on your vending route, right? Or someone complains, who knows, something can go wrong. So a single member LLC, once again, is the best way to go about starting for that legal liability protection. And then, so the next question is, at what point should we consider becoming an S-Corp, right? When is that time? The ideal is, I'll provide a dollar figure. I'll say when the profits of your vending business is greater than $70,000 per year, okay? So once again, it's not revenue, it's profits, right? So this is, your gross sales minus your cost of goods sold, minus your financing or leasing, you're purchasing equipment, you're paying for it on an installment basis, minus all the expenses that go along with your vending, even your VP membership, that's also a deductible expense, right? So when your net profits, once again, is above 70,000 to 80,000, I say that is the time where you should consider becoming an S corporation.
Interesting. Why that number?
Yeah. So within S corporation, like I mentioned before, there's a lot of administrative duties and responsibilities. And the big one here is reasonable compensation. Okay, so if you have an S corp or you start an S corporation, you have to pay yourself a salary as the owner. Okay, that's an IRS requirement. And over the last 4 years, based on experience, the IRS is really cracking down on S corps and their owners who don't pay themselves a reasonable salary, right? And reasonable, I'll go into that in just a little bit of detail here, is basically what would you pay someone doing your role, putting in the time and effort, as well as in your region, what would be your replacement cost, right? For all the things that you do for your business, what is the salary you would pay them? That is considered reasonable. Right. And there is no, and I've heard this a lot from, clients, and 50-50, right? Some people are like, I'm just going to split my profits at the end of the day, 50-50. That doesn't exist within the IRS, right? There is no 50-50 rule. There is no 60-40, 70-30. That does not exist anywhere, right? That's just kind of like a wish and a prayer, right? I'm just going to do 50-50 and hopefully the IRS will accept that. What the IRS wants is documentation. They're going to be like, okay, how did you come up with that salary that we see on your tax return? What is the supporting documentation? Did you look at census reports? Did you look at the Labor Bureau statistics? Like, how did you come up with that? You can't just say 50-50. You can't say, my accountant just told me, or I just did 1,000 a month times 12,000, right? They know all of that, right? They've seen it. And the big risk there is if they come back and they audit it, and they are auditing this heavily nowadays, if they come back and audit you and they determine your salary that you paid yourself, let's say last year or 2 years ago, is unreasonably low, and there's no documentation, first and foremost, they might convert all of that as salary, all of your profits, right? And be like, okay, so we're gonna assess payroll taxes, that's FICA, right? Unemployment, all of these taxes plus penalties and interest for the salary you didn't take, right? That was supposed to be reasonable.
Interesting.
And I'm just thinking about this here because, like, when you have an S-Corp, how I understood it of what the best tax benefit of by going with an S-Corp was that they weren't getting flagged. Now you're saying that it's kind of changed here over the past couple of years, where they are getting flagged now. So it was my assumption where, like, okay, just say you brought in, and I'm not saying, I know you said profits, but just say it was $100,000 revenue, right, for the business. You would pay yourself maybe 30% or 35% of that as a W-2 salary, right? So then that would be 35, and then you would have all your other remaining, $65,000. I'll just use it as a simplistic example, with this, and then you deduct all your expenses and everything like that you have over there, and then all that other money that's left over off of that you can filter through yourself as a distribution. So then that way you can kind of circumvent the FICA tax. They're like the self-employment tax, basically.
Yeah.
Are you kind of saying the same thing here, or
Yeah.
am I understanding it, or no?
No, that's a great understanding, Anthony. So that's a great lead-in, right? Because with an S corporation, the complication comes with you have to pay yourself a salary. How do you pay yourself? There's two ways, right? There's that salary portion that we just talked about, the W-2. The second is distributions, right? Which you just alluded to. That's basically $100,000 in your example minus, let's say, $30,000. Let's keep the numbers clean. So $70,000 remaining. $70,000 minus all your cost of goods sold, your memberships, all that stuff. Let's say there's $30,000 remaining, right? Let's say we have like a 60% profit ratio here, right? We're trying to get above 50%. I'm on your foundations call, Anthony, always, right? So we're trying to get above. We're always trying to pump that up. So that remaining amount is considered distributions. And that is the game that we're trying to play, or the strategy we're trying to implement is to not pay FICA taxes on the remaining, right, on that distribution portion, right? Because the payroll taxes or the W-2, you're subject to FICA, unemployment taxes, but it's the distribution side that's not subject to payroll taxes like FICA and unemployment. So that's why people become S-Corps, like you were saying, Anthony, right? Because we want to avoid paying FICA taxes on all of our profits at the end of the day, right? We just want to pay a portion of it. And going back to, yes, technically the IRS maybe was not focusing on S-Corps, right? So a lot of people chose S-Corps because maybe they can fly under the radar. But the last couple of years, they've been heavily focusing on that, right? And the real key here is on your S-Corp tax return, there's a line, salary for officers, right? That's like the first expense after cost of goods sold, right? And if there's no number there, that's a red flag. And remember, this is not like a person looking at these returns. It's a machine, right? That's going through this. And if there's no data input on that line for salary or compensation for officers, boom, you are most likely going to get a letter asking for, why did you not pay yourself a salary?
Yeah, that's a great question. So my question back to you would be, when you're just starting a vending business, there's a lot of CapEx expenditures that you're having. There's a lot of inconsistent cash flow, like earlier on in the beginning, as you're growing and scaling, right? And, there's months that you're not profitable. How do you handle that,
Yeah, great question. So going back to earlier in our conversation, don't become an S-Corp right away, right? There's that threshold that I was talking about, right? Once your profits for the year are going to exceed, let's say 70, 80 grand, right? Profits, right? Once again, profits, not revenue. That's when you should start thinking about S-Corp. Do not elect S-Corp from the beginning. That's, at the end of the day, a lot of people are like, I'm going to be an LLC and then I'm going to become an S-Corp right away from day one. I highly advise against that because of all the administrative burdens. And like you said, Anthony, the cash flow is an unknown in the very beginning, at least for the first year or two, right? You guys experienced it where you're not sure. So why add an administrative burden of operating an S-Corp, paying yourself a salary and wages on top of that stress, right? We don't need that. So that's why the threshold really is you need to have a decent amount of profits annually, between 70 and 80 at least. That's like the starting point to really legitimize the tax savings and the administrative burden of becoming an S-Corp. So long story short, don't become an S-Corp from the very beginning.
That makes a lot of sense. That's awesome. Now, we talked a little bit about entity structure. One thing that I know is very passionate to why Anthony and I got into vending in the first place is ultimately the deductions and the depreciation that allows you to maximize those write-offs as a vending operator. So what expenses are most commonly missed by vending operators, and which ones provide the largest tax benefit for an operator?
Yeah, great question. So I'm going to tie in the new One Big Beautiful Bill with this.
Perfect.
With this question, right? And we'll call it OB3, okay? Just to kind of that's how we kind of refer to it. With the new tax bill, OB3, depreciation is a big expense that vendingpreneurs can definitely utilize. It's section 179 and something called bonus depreciation. Okay, those are two really big ones. What that is section 179 is basically you can write off 100% of the cost of the machine. Same thing with bonus depreciation, it's 100%. However, what's nice about section 179 is you can kind of pick and choose which machines, what CapEx expenses you're going to really just write off completely. And you can kind of do the regular depreciation for the other ones, right? So you can kind of cherry pick. And one thing that I always recommend to clients is it's nice to have zero tax, right? But at the same time, you have to weigh, before you start implementing depreciation, max depreciation, bringing your income all the way to zero, think about your life circumstances. What's coming up in the next year or 2 or 3 years? Financing is a big one that we always talk about in the VP community, right? When you apply for financing, with the bank, they want to see a business with profits, right? Of course, they can add back depreciation, go to earnings before income taxes and depreciation, but they want to see some kind of taxes being paid. That's an indicator for them that, okay, this is a viable, a profitable company, right? They're just not writing everything off. So you really have to think holistically instead of just on an annual basis with tunnel vision, because some of our community members also might be applying for a mortgage in a year or two as well. Right?
Yeah, that's a good point.
Yeah, so when you're looking at implementing 179 bonus depreciation, trying to pay minimum taxes, you really have to think, I would say at least 2 to 3 years ahead. Think about, is my family or is my spouse and I going to apply for a mortgage? Or am I going to apply for business financing with my local bank, right? Or, with another lending option? Because they're going to ask for tax returns and they want to see a profitable business, right? Not a business that wipes out everything or is reporting a loss, right? Because with section 179, you cannot take a deduction past zero, okay? It will not bring you to a loss. But with bonus depreciation, you can actually report a loss. It'll take you into the negative with bonus depreciation. Okay, so that's a big distinction between the two of those. But once again, you have to think holistically about your personal situation to think about, am I going to apply for business financing? And what are some of my personal goals that my family and I want to pursue in the next 2 or 3 years, right? Because that's very important to answer those before you start writing everything off, okay? With depreciation, because I bring depreciation as the main one because that's the largest deduction that all of us in the community probably have at our disposal, we'll say, because you can choose, am I going to write off everything or just a portion of it over 5 years, right? So really thinking about these holistic questions first and then implementing the strategies is going to be key, I think, when it comes to tax reporting time.
Yeah, it's a great point. So 2 questions. One, with this being passed this year in 2025 is when we're filming this video of December, can it go back like, so 2024, 2023, say you started your business and you, just like myself, I bought a ton of equipment last year, you know, like, does that just go from 2025 going forward, or can you go back and claim that depreciation for your future tax returns?
A great question, Anthony. So with the OB3 or the new tax bill, it applies to 2025 when it comes to depreciation. There's certain items in the tax bill that don't apply, but when it comes to depreciation specifically, the 179 bonus, it starts basically Jan 1 through December 31st of 2025, okay? However, one stipulation is only equipment purchased post January 19th of 2025 is eligible for 100% bonus or the 179 under the new law, okay? So most people probably, majority of the year qualifies for all the equipment that you've purchased. But if you purchased it earlier than January 20th of this year, it doesn't really apply. The old rules apply to that for that equipment, okay?
I need you to find me a loophole, Steven. I need you to find me this loophole for all of the last 2 years, man.
Yeah,
come on, buddy. It's the books. Find that section 181 or something, man. Give me something.
But you know what? One nice thing, strategy is you can go back and amend previous returns, right? Let's say you took a lot of depreciation, right, in previous years, and you're like, oh, I want to take that back, right? I want to kind of recalculate because I need to show income, I need to show profits, right? Or I need to apply for a mortgage. That is possible because the lender is going to ask you, send me the most updated filed returns. Right? So you might be able to adjust and amend those previous returns using the old law, Anthony, right? Using the old law that existed before OB3. So that is always a possibility. However, there's a bunch of other things that come into play when it comes to like the statute of limitations for audit that is extended once you amend that return. But going back to, you can adjust previously filed returns and kind of change some of the accounting method used for like depreciation. So that is a possibility.
Now, speaking of audits, how do you suggest people properly track COGS, collections, shrinkage, all those things, that would hold up?
Yeah, great question. So first and foremost, you go to the source, bank statements, credit card statements, checking account statements, 1099Ks, right, that you're going to get from, the payment processors, right? You're going to get all these tax forms. You want to have a digital copy. Gone are the days where some of us might still have boxes, like shoe boxes, we'll say. You just kind of put all your expenses in there, paper copies, but I don't recommend that because fires happen. The spouse can come and throw everything away mistakenly. Things happen, right? So what I would say is keep a digital copy of all those records, right? And the nice thing about if you are banking with Chase, Bank of America, any of the larger ones, they usually have 2 to 3 years digital statements already waiting for you, and you can go and request those, right? If you need further back. But what I would say is come tax time every year, this is kind of like February, March, I would just download all the previous year's statements and save it into a folder into the cloud, right? Not on your hard drive, right? Because that, we all know that computer issues do happen. So save it to like Dropbox. And most of us probably have a Google business account, I would say, like Gmail. Mm-hmm. Put it in your Google Drive, right? Have a folder for like 2024 or 2025 and put all your bank statements, credit card statements, all your tax forms in there, and have it saved into the cloud so that if something were to happen, you have access to it. So that's step one. Save the source files, right? Save all of that source documentation first. Second is get accounting software, like bookkeeping software. All of us know QuickBooks. What I recommend is actually Xero. It's Xero. That's how it's pronounced Xero, but it's actually spelled Xero. That's a lot more user-friendly, I would say. A lot of my clients like to use Xero, as well as a lot of my clients. That's the one I recommend. So that's step number 2, use accounting software, okay? And you should be using accounting software every quarter, at least to pay quarterly estimated taxes, right? That's another topic, and we can cover that as well. But you need to know how your business is doing, at least on a quarterly basis. I say monthly, but at least quarterly. See, are you profitable? Are you not? You want to track that, right? So that you can calculate things like taxes correctly.
No, absolutely. Yeah, that kind of segues into the next question that I have. But really appreciate everybody watching here. Please click the button and subscribe to the channel. Continue to see more videos that Mike and I continue to go ahead and produce. So appreciate everybody watching. But Steven, just to kind of segue into the quarterly taxes of estimated. So One of the things that attracted me so much about the vending business is not even just a low barrier of capital entry to get into the business, but like the cash flow rich, especially coming from a real estate background where I would get paid in chunks. Vending is a very predictable business of income, and then just how us owners are paid out weekly of cash. It gives us the flexibility to be very creative with cash flow of like paying this, paying that. Like it really gives us the flexibility as operators to kind of get really creative. So like, how should vending operators like realistically calculate like quarterly, like their estimated taxes, like when, you know, revenue swings, you know, or just like when the revenue's coming in, and then like obviously dealing with some of the seasonalities, like we just got done with Thanksgiving, we're entering into Christmas, you know, with dealing with those seasonality type swings. So can you touch a little bit on that?
Yeah, great question, Anthony. So quarterly estimated tax payments, it is a requirement. Okay, I just want to tell all the viewers out there, it is a requirement if you are liable for taxes. Okay, so that means if you have profit, you have to pay taxes. Okay, if there's no profit, there's no taxes. Okay, so let's get that for if you have profit. Early on in a vending business, you might not have any profits, right, Anthony? You know, it might be kind of slow. But it seems like when we talk to other vendingpreneurs, it comes in like waves, right? You know, you might sign 2 contracts at once, 3 contracts. So the seasonality and the inconsistency sometimes of cash flow in the very beginning is going to be tough, right? The consistency in the very beginning. As you progress a year, 2 years, 3 years, as you establish your business, it might be a little bit more predictable, okay, when it comes to cash flow, like you're saying. What I recommend is if you have profits, you should utilize, there's something called a safe harbor method, and there's something called the actual method, right? Or like the annualized method. I say use the annual method. And what that really means is if you've been tracking your income and expenses, like we highly recommend using, you know, accounting software, then you know what your profits are. At the end of every quarter or at the end of every month, you should know year to date where you lie. What's your profits, right? Where are you if the year were to end today or, you know, last month, right? So using that number, what you do is you basically have to find something called your effective tax rate. And that's going to be, you look at your previous year tax return. What I would say is look at your previously filed tax return. And then if you use TurboTax, if you had a CPA, if you had an EA, reach out to the professional and ask, what is my effective tax rate? Because that tax rate is going to be important to calculate how much taxes that I need to submit to the government. And remember, there's 2 taxes here for quarter. There's federal and there's state. They are not connected by any means, right? So you have to submit at least 2 taxes, one to the IRS and then one to your Department of Revenue or your franchise tax board. Okay, so there's gonna be 2 different places. So you have to calculate 2 different types of tax, but find the effective rate for both of those, federal and for state, okay? So whatever your profit is year to date, multiply that by that effective rate, okay? And then divide by 4, okay? So what that means is that seasonality of income and expenses that we say, that cash flow when it's inconsistent, if you're using that method every quarter, you'll know if you had a really slow quarter previously that I'm gonna stay consistent, whatever that annual year-to-date amount is, right? It adjusts then, right? Because you divide by 4 and you figure out maybe I paid too much last quarter. So whatever that is, I'm gonna adjust for this next quarter, okay? Maybe you had a great previous quarter, then that amount you have to increase, you bump it up, basically. You do that calculation again. In quarter 1, you divide by 4. Quarter 3, you divide by 2 because you only have 2 more remaining quarters to pay, the taxes that are due. And then quarter 4 is basically the touch up. You true up everything, right? Where you're like, okay, how much do I need to pay? Because I know how much profit I have as of December 31st. Right, so that's how we say it. We call it the annualized or the actual method, and that's what I really recommend for vending operators because of the seasonality, the fluctuations that you mentioned, Anthony.
For sure. What cash flow system works best for making sure money is set aside for taxes despite fluctuating machine collections? Like, what do you suggest?
Yeah, the best and easiest way is to open up a savings account, another bank account, right? And what I would do is every month, if you've been tracking your profits, apply a certain percentage, let's say it's 20% or 30%, and just transfer that money from the main operating account to that new savings account, or let's call it the tax account, transfer that over and set it and forget it, right? Do not touch that money, and it's only for taxes, okay? It's not an emergency fund account. It's nothing for anything else. And that's the best way to do it, so that when you come tax time, quarterly basis, you have something in that account ready and waiting for you, right? And a lot of people say that, after paying my quarterly tax, if I have something left over in there, can I use it for the business? No, just leave it in there and then just let it roll forward, right? Because, things happen in life where sometimes we're not able to transfer all, what we need to transfer over there. So just keep it in there. That's just the tax account, okay? Just leave it as tax account. And I would be actually more conservative than aggressive. Have a higher percentage, maybe like 25, 30%. I think 30% should be suffice for most operators, I would say. That would cover both federal and state, is about a 30% rate.
Got it.
Awesome.
Okay.
Great. That was super helpful. Now, Stephen, kind of switching gears from the quarterly payments and back to the beautiful big bill and just some key changes with that. Like, what specifically about this new bill should we be thinking about, and both from the the depreciation but also the deduction side of things?
Great question, Mike. When it comes to the OB3, the new bill, the biggest change is depreciation. So the 179 that we talked about, the bonus depreciation, those are the biggest changes for vending operators. When it comes to other deductions, right, like insurance, mileage for your vehicle, home office, right? Some of us are using parts of our garage or our entire garage, right? For storage, right? For inventory. You have to utilize that square footage, right? Don't forget that home office deduction. But basically, the depreciation, that was the biggest game changer with the OB3. All the other deductions, when it comes to writing off for your business, those pretty much stay the same. Remember, a deduction, the baseline test is it ordinary and is it necessary for your business? Those are the two. That's the baseline test by the IRS. Is the expense ordinary in our industry? And number two is that a necessary expense for our industry? Right. So buying a private plane probably is not ordinary, and it's probably not necessary, right? For our business, maybe one day, right? But things like that. People always ask, can I buy a luxury SUV? Right, like an Escalade, a large one for my vending. It's probably not ordinary. It might be ordinary, but it's probably not necessary, right? You have to match both of those tests, right? So when it comes to expenses, ordinary and necessary, that is the baseline to justify an expense that you're taking as a deduction.
The home office one, so I have a home office, but then when I first started out the business, I was using my garage as my warehouse. So like I would be able to total up both square footages, right? And that could be used as that?
Yeah, you can technically. And there's a term for that. It's called the accountable plan. Okay, so accountable plan, and what that is you'll get a larger home office deduction using the accountable plan method versus just the standard home office method. Okay, and what the accountable plan really does is it takes the percentage of your home that you utilize for the business directly, Anthony, right? So like, let's say you have an administrative room that might be 300 square feet, but you also are utilizing your garage and parts of your basement or your entire basement, right? You wanna measure out the square footage of all the space used and dedicated to the business, right? One thing that does get people in trouble is if there's a space in your house where it's a mix of personal and business. So like, some people say that, hey, my dining room table is my home office, right? Or like my living room's couch or my sofa, my living room is my home office. That technically might be true, but when it comes to the home office, it has to be regularly used and exclusively used for the business, that area, okay? Regularly and exclusively. So I want everyone to take a grain of salt with that, right? You have to make a judgment call, right? Are you regularly using it? So your living room couch, it has other uses for that, right? It's not just for vending operating, right? Your dining room table has other uses as well, right? You're not only operating your business from that dining room table, you're probably eating meals with your family. So really, when it comes to home office, but when you have a garage or a closet or a basement that's like packed with Takis, Flamin' Hot Cheetos, drinks, all that stuff, and it's just that is
Oh,
what
it's
you're
crazy
using it for.
because like it's so funny when people are first starting out in the community, like they join our Wednesday community call that Mike hosts every single Wednesday, and everybody's all on there, and you could tell like the most successful operators, like they always join that Wednesday call that Mike has, and it's so funny when they share their screens in the beginning of 4 or 5 months, like they'll have racks of gummies, like it's literally like like a Walgreens inside their place, and they're sitting there on the camera, and I mean, that's what they're using to kind of go ahead and get started. You know?
I was watching the most recent YouTube one that was released yesterday. I think you guys shot it in November. It was a female operator that you guys just released that video, right? And she was kind of like, it didn't show.
Yeah. She had the Takis in there too.
Yeah. So I totally understand. And half of my garage right now is filled with potential items to sell, right? So, but anyways, exclusively and regularly, right? That space. And look up the accountable plan, everybody. Okay, if you are looking at really how do I maximize my home office deduction, or deduction for the usage of my home, that's probably a better way to put it. Look up the accountable plan, and it'll show you kind of what is the formula. You take your square footage exclusively used divided by the total square footage of the home, and that comes up with a percentage, right? And then once that percentage, let's say it's 10% or 20%, then you start calculating up all your utilities, your mortgage payment, your rent, right? If you know all of those things, and you apply that percentage that was calculated in step one to those expenses, right? So the accountable plan really, it's at the end of the day, it's a reimbursement plan from the business to your personal for the usage of your personal, right? So that's what it is. So accountable plan, that is the term, to really maximize the home office deduction.
What are some strategies for vending operators to consider now to prepare for their upcoming changes in like 2025, 2026? Like, what are some like your prep type, checklist type things that these operators need to go ahead and do?
Yeah, first is gather your expenses, right? Really track that, because when you're first starting, and I just think about my journey here, right? It's very new, but there's a lot of random expenses I used on my personal card, right? From my personal checking, that was towards the business, right? That I might forget come tax time when I need to actually expense that from the business. So get organized first and foremost, right? Look at first when you first started your vending business, right? When you first enrolled into the community, track all those expenses. Open up a Google Doc or Google Sheet and just row by row, put in all the expenses and the category that kind of falls into. Was it an office supply? Was it a membership? Did I make an order out of VendHub, right? Whatever it is, just itemize everything out and get organized first and foremost. You want to expense everything that you're eligible for, right? That is the biggest thing. And then number two is hire a CPA or a tax person in your area, someone that's local, to your state. I know we're trying to save money, but DIYing it, especially when it comes to depreciation, is a nightmare. I will tell you that, okay? So spend, and that's a deductible expense. Once again, if you hire a CPA or someone in your area, it is deductible, okay? So it is not an expense or some cost that you just lose. Track that, and then also ask them the questions for your area, for your state, for your local, because sales tax questions, reasonable compensation, all the stuff that we just talked about, you want to go to that's local and that knows your state and your jurisdiction, right? Permitting, all these things, they probably have a lot of advice for you just there, right?
That's a good point.
Yeah, so hire someone, find out, ask your buddy or your family member in the area, do you have any recommendations for a CPA? Who do you use? And get maybe a list of 2 or 3 of them and interview them now in December or like in early January before tax season hits. I don't know when this video is going to release, but you do not want to be contacting them to vet them during tax season. They will not take your calls. They will not meet with you. They will, that is the wrong time to reach out. That is the last time to reach out. So do it early and vet 2 or 3 people through 2 or 3 personal recommendations that you get, and hire an accountant. Yeah.
Last question, because you brought up something that I'm curious to hear your answer on this. So when people are first starting out, they might not have the business credit card of a good substantial amount limit on there, right? But they might have a personal credit card where it might have a zero balance, but they have $20K compared to the $5K that they just got approved as a chasing card, right? Can that person use that $20K personal card if it's just used for business expenses?
Absolutely. Yeah, there's no problems there. Once they get established, I would tell that person not to depend on that for the life of their business. But in the very beginning, yeah, you can utilize that. Just track it.
Got it.
Make sure, download the source documents, right? And just have a record of all that stuff. So.
Got it. Awesome. Everyone, this was Stephen Lee's story here. If you're interested in joining Vendingpreneurs along with other successful vending operators like himself, then click on the link below to book a call with us today. So, Stephen, appreciate you coming on here. One location already in the works, 4 others potentially coming down the pipeline here. So Q1 2026 looks pretty powerful for you. So make sure you got your tax account set up there on the side so you can start buffering for that.
Absolutely.
Thanks, Stephen.